Before we get into it, nothing here is financial advice, just my opinion. Cerebras opened at $350. 6 weeks later, Mr. Market offers the same shares at $181. Cathie Wood bought 22 million. Morgan Stanley said buy. But the stock is down 42%, and the margin miss just made it worse. Is he depressed or finally telling the truth? Stick around, you'll know by the end. And if this was useful, go ahead and like the video. It helps the channel grow. Cerebras builds the biggest chips on the planet. Every other company slices a silicon wafer into hundreds of small pieces. Cerebras uses the whole wafer as one chip, the size of a dinner plate. They call it the wafer scale engine. It handles AI models too large for Nvidia's hardware. OpenAI signed a $20 billion deal. Amazon has a separate multi-year partnership. Bull case, only real Nvidia alternative. Bear case, Nvidia's software moat is unbeatable. So how did we get here? The 4-hour chart tells the full story. Cerebras went public in mid-May and opened at $350. The stock ran hard on day one euphoria, then started fading immediately. 6 weeks later, it sits at $181, down 42% from the open. The key date was June 24th, earnings day. The margin guidance disappointed, and the stock lost a quarter of its value in 2 days on 4 times normal volume. That is not a normal sell-off. That is capitulation. Now look at the volume profile on the right side of the chart. The heaviest concentration of volume sits right here, $175 to $200. That is where the most trading has happened. The stock is sitting at the point of control, which means this is where the market is price discovering right now. The Harzi at the bottom is reading -22, approaching oversold but not quite there yet. The UMEA score is 3 out of 6. The system is calling a macro short trend lock with an oversold exhaustion reading. That tension is important. The trend is bearish, but the selling may be running out of gas. Key support sits at 177 and 171. Resistance above at 229. If support breaks, there is not much holding it before 150. The chart is telling you exactly what the earnings already told us. The thesis is real. The price is the question. $604 million in trailing revenue, up 25 times in 4 years. That growth is real. Gross margin hit 44% in the first quarter. Operating loss, $43 million. Free cash flow, negative $273 million. Here's what that burn actually means. They're building infrastructure to fulfill the OpenAI deal. Spending to win. Revenue is real. The burn is deliberate. $2.2 billion in unrestricted cash. Another $1 billion in restricted cash tied to data center leases. That money is not freely usable. Total liquidity, $3.3 billion. But the debt, $620 million owed to OpenAI, $360 million elsewhere. Net cash after debt, about $1.2 billion. Then there's the part most people skip. $2.95 billion in preferred stock, sitting senior to every common shareholder. Gross margin hit 44.6% in the first quarter, 3 straight quarters of improvement. Then the guidance for the second quarter dropped, compressed to 36 to 38%. The cause is specific. Cerebras is signing data center leases to fulfill the OpenAI deal. That's where the $1 billion in restricted cash went. Bull case, temporary, margins recover once infrastructure is live. Bear case, this is just what the deal economics look like permanently. Cathie Wood bought 22 million during the dip. Wood runs concentrated bets. She doesn't move without conviction. Craig Hallam came in with a buy rating and a 325 target. Morgan Stanley said buy the dip. 3 institutions, 3 independent signals, all buying while retail was selling. Smart money and retail money are pointing in opposite directions. One of them is wrong. At 181, Cerebras has a $40 billion market cap. On $604 million in trailing revenue, that's 65 times enterprise value to revenue. Nvidia, the most dominant chip company alive, trades at 15 times. You're paying 4 times the Nvidia multiple for a company that's still losing money. Bull case, you're paying for growth. Bear case, 65 times with negative earnings is priced for perfection. Perfection is expensive insurance. 4 reasons to be bullish. 1, their chip handles workloads Nvidia's hardware literally cannot. 2, OpenAI committed $20 billion. Amazon Web Services has a separate deal on top of that. 3. $2.2 billion in unrestricted cash, years of runway, no forced dilution. 4. Stock compensation is only 3% of revenue. At this stage of growth, that kind of discipline is almost unheard of. 3 risks. 1. Nvidia's CUDA ecosystem locks developers in at the software level. That moat doesn't break easily. 2. You're paying 65 times revenue for a company with negative cash flow and $1 billion in debt. 3. $2.95 billion in preferred stock sits senior to every common share. And here's the one most people miss. Your biggest customer is also your lender. OpenAI holds a $620 million loan against you. Every stock I cover, I measure in gold ounces, not just dollars. Here is why. Dollars inflate over time. Gold does not. If a stock is rising in dollars but losing ground in gold ounces, you are not building real wealth. You are running to stand still. Gold keeps me honest. So here is the math. 1 share of Cerebras today costs $181.59. 1 ounce of gold is trading at $4,088. That means 1 share of Cerebras buys you roughly 0.04 of an ounce of gold. Now compare that to the IPO price. At $350 on IPO day, with gold at the same level, 1 share bought roughly 0.09 of an ounce. That is nearly double. In 6 weeks, the stock lost 42% in dollar terms and 48% in gold terms. The company did not change. The hype did. I will track this number every time I check in. If the stock is buying more gold ounces over time, the thesis is working in real terms. If it is buying fewer, even a rising stock price might not be keeping up. That is how we measure performance here. Dollars and gold ounces, both. Revenue up 25 times in 4 years. The growth is real. Gross margin at 44.6%, but the second quarter guidance is heading lower. Operating margin still negative 29%. Free cash flow negative $273 million. That's the infrastructure build-out. Cash, $2.2 billion unrestricted. And the part most buyers ignore, $2.95 billion in preferred stock sitting senior to common. The trajectory improves. The risk is still there. Cerebras is not a value stock, it's a bet. The world needs an alternative to Nvidia. At 181, you're paying 65 times revenue for that thesis. If you believe it, this might be your entry. If you don't, the price is dangerous. We laid out every number, every risk. You make the call. Every episode, 1 stock, 1 honest scorecard. We show you the math, you make the call.